All right, let's dive into a fascinating puzzle coming straight from Wall Street. You've got this company, Asana, and they just dropped a pretty solid quarterly report. Looks good, right? Well, two of the biggest banks on the planet looked at the exact same set of numbers, and they came to completely opposite conclusions. One is screaming buy, while the other is warning sell.
So how in the world does that happen? How can one report, one set of facts, be both good news and bad news at the same time? That is the core question we are going to unravel right here, right now. Let's get into it.
And here it is, laid out plain as day. On one side, you have Bank of America, feeling super optimistic. They're slapping a buy rating on Asana with a $19 price objective. But then, on the other side, you've got Morgan Stanley pumping the brakes hard. They're rating it underweight with a $14 price target. Same company, same report, totally different advice. It's wild. Okay, so here's our game plan. We'll start with the undisputed facts from the report. Then we'll explore why Bank of America is so bullish and why Morgan Stanley is so bearish. After that, we'll decode what's really driving this divide, nail down the key takeaway, and wrap it all up with one final, big picture question.
First up, the Q2 report card. Let's start on common ground, the hard numbers that nobody is arguing about.
So the headline numbers, they were undeniably strong. Revenue clocked in at $197 million, which was better than anyone expected. Billings, which kind of gives you a sneak peek at future revenue, that was up too. And this is a big one. Operating income was $14 million, way ahead of what was forecasted. So on the surface, everything's looking pretty rosy. Okay, now to really get this debate, we need to understand a key term, net revenue retention, or NRR. For a software company, this metric is, well, it's everything. It basically answers the question, are your current customers sticking around and spending more money, or are they spending less and maybe even leaving? Over 100% is great. Below 100%, that means you're leaking revenue.
Asana's NRR came in at 96%. And yeah, that's still below that magic 100% mark. But, and this is the crucial part, it's the trend that matters. That number actually ticked up from 95% the quarter before. I know, it's just a tiny 1-point improvement, but believe me, that little change is at the very heart of this entire debate. Remember that 96% number.
Another quick term for you is annual recurring revenue, or ARR. Think of this as the steady, predictable, subscription-based income that's the bedrock for a company like Asana. We're going to look at this through a very specific lens, their new AI products.
And whoa, check this out. The recurring revenue from Asana's new AI studio, it more than doubled in just one quarter. Now, full disclosure, it's growing from a small base, but still, that kind of explosive growth is a powerful signal. The question is, how much does that signal really matter for the future of the entire company? Okay, that's the setup. Let's dive into the bull case. Here's why Bank of America is telling its clients to buy. You can get the whole vibe just from the title of their report. Greener pastures ahead? They're essentially looking over the horizon, past the current issues, and seeing a much brighter future. For them, this Q2 report isn't just a good quarter. It's the first real sign of a major turnaround. So for Bank of America, that little 1-point tick up in NRR isn't a blip. They see it as a huge turning point. It's proof that customer retention is getting better. And that explosive AI growth, they see it as a massive catalyst for the future. They also point to strong growth in areas outside of the tech industry as a sign of resilience. And bottom line, they just think the stock is cheap and has a lot of room to run. Now, Bank of America isn't just wearing rose-colored glasses here. They acknowledge the risks. They know that changes in AI-powered search engines could make it harder for Asana to find new small business customers. But when they weigh it all up, they call that risk real but manageable.
All right, that's the bull case. Now let's flip the coin and hear from the bears. Let's dig into why Morgan Stanley is so cautious.
And again, the headline tells you everything you need to know. Q2 strength meets 2H challenges. Their whole argument is basically, sure, Q2 is nice, great job, but don't pop the champagne just yet, because we see some serious storm clouds on the horizon for the second half of the year. So their concerns boil down to 4 main points. First, they say the full-year guidance was effectively cut because it wasn't raised by the full amount of the Q2 beat. Second, they're much more worried about those headwinds hitting small businesses. Third, they see continued pressure from their big tech customers, who have a lot of contracts up for renewal. And finally, yeah, the AI growth is cool, but they argue it's just a drop in the bucket, nowhere near big enough to offset all these other problems.
And this just perfectly illustrates the divide.
Remember that 96% NRR that Bank of America called a positive inflection point? Morgan Stanley looks at that exact same number and says, nope, it's too early to call a trend. They're just not convinced that one single data point signals a real, sustainable turnaround.
Okay, we've heard from the bulls, we've heard from the bears. Now let's put them head-to-head and really decode this divide.
This lays it all bare. Let's go down the list. The outlook for the rest of the year? BofA sees a raise, Morgan Stanley sees an effective cut. That critical 96% NRR number, BofA sees a turning point, Morgan Stanley says it's too early to tell. Those small business headwinds, BofA says it's a manageable risk, Morgan Stanley sees it as a key concern. And the AI impact? BofA sees a bullish catalyst, Morgan Stanley says it's still too small to matter. It's 4 key data points and 4 completely different interpretations.
So what's the big picture lesson here? Why does any of this really matter? Ultimately, this whole debate reveals a fundamental truth about investing. The data alone is never enough. It always requires interpretation. Financial analysis isn't just about what happened in the past, it's about building a story about what you believe will happen in the future. Bank of America is telling a story of recovery and AI-fueled growth. Morgan Stanley is telling a story of market headwinds and tough challenges. Both stories are rooted in the exact same set of facts.
So how will we know which story ends up being right? Well, here are the 3 things to watch. First, how fast does that new AI product actually roll out and get traction? Second, what happens with those small business customers and their website traffic? And third, how do those big, important renewals with tech companies go later this year? The answers to those questions will tell us whether the bulls or the bears had the clearer crystal ball.
That all comes down to one essential question, right at the very heart of this debate.
In the end, it really all boils down to this. Which of these 2 powerful forces will win out? Will it be the exciting, massive potential of new AI-driven growth that's just starting to ramp up? Or will it be the powerful market headwinds that are challenging their core business right now? The answer is not only going to decide the fate of Asana stock, it's also going to tell us a whole lot about the broader tech landscape.